Hello and welcome. Yes, it has happened. The merge actually took place and it went very, very well, according to all accounts. And welcome to the stream, Manuel Rensink from Securrency. You are Director of Innovation and Strategy there. And the reason I brought you on, Manuel, is to talk specifically about not what happened today, but what might happen in the coming months and years as this new era of Ethereum exists. How was it for you, kind of just taking up the last couple of weeks, thinking about what the merge would be and watching this from your position?
Yes, well, first of all, thank you for having me. It's a great pleasure. Well, we've of course been expecting the merge for quite a while, and I think until maybe a week ago, I was still not sure if it was going to happen. But I guess we were never as close as now, and now it finally happened. So I'm happy about that. I think it's good for environmental reasons. I think a big part of what I do is try to bring TradFi and DeFi together, bring real world assets into DeFi and onto blockchain, and really try and make it help changing the lives of real people, right? Not just the degens and the nerds and the whales. So I think from that perspective, it's good because it's for sure it will draw in institutions now as well. Now that ESG issue has been resolved, and I think it will have a positive impact also on, of course, the gas prices, the transaction fees. But then there is something something else that I've been quite excited about for quite a while with proof of stake. And that is, of course, the proof of stake rewards that offer a yield to investors. And so I believe that this will really be the beginning of a new era of yield, fixed income in DeFi as well. DeFi so far has not really seen any fixed income. It's always been variable yields, and that's not that interesting for people.
Well, but you say that, but of course, DeFi has seen a fixed income product, and very famously, it was Anchor. And Anchor's promise when it launched was to be the benchmark rate of fixed interest products for the whole crypto ecosystem. And I thought that was incredible, and I was fascinated by this, but they set it at 20% and it sort of started to drift off. But we know what happened. We know what happened next. So when you say it hasn't happened before, it has, and it blew up. So taking that into account, are you still excited about what ETH 2.0 can offer to this space?
Yes, and you're right. Of course, Terra offered kind of a fixed yield, but it was really the big problem was, of course, the quality of the collateral and the system underpinning it. So, anybody can offer a fixed yield, but can they offer it sustainably? And the answer was obviously no. The collateral was of poor quality. They didn't have enough time to bring in other types of collateral, as for instance Bitcoin. And so then the whole thing collapsed when trust in Luna evaporated. So with proof of stake, I think we have a very sustainable type of yield. So I mean, other people will say it's not really a yield. They might say it's not a yield for regulatory reasons, but I'll set that aside. So it's of course rewards, but it's something that can offer a sustainable yield. That does not change significantly over time either. So we can expect, for instance, the Ethereum yield to fluctuate between 5 and maybe 8%. It can persist over the long term, and it can remain relatively high, even with very large amounts of capital being deployed into it. So it's very liquid as well.
Well, that's I think one of the things that was so interesting about Lido was the ability to stake ETH but keep it liquid. Let's rewind for a second, talk about Securrency. Just before we got on the stream, you were talking about making securities more liquid and creating a more liquid market for everything. How does this fit into that mission for your company?
Yeah, so as I mentioned before, a big part of what we do is is well, we operate at the intersection, let's say, of TradFi and DeFi, and we want really for DeFi to work. We call it sometimes real DeFi or institutional DeFi. We want it to work for the 99%, right? Not just for the 1%. And so we are looking to not only work with cryptocurrencies, although we think cryptocurrencies, a lot of them are amazing, but we are also looking to bring in so-called real-world assets and bring that into, for instance, DeFi protocols, a lending protocol or swap protocol, and these can be themselves yield-bearing assets, right? This could be a loan portfolio of a bank. We've seen it with now with MakerDAO, for instance, where HVB Bank is putting a yield-bearing loan portfolio into a DeFi protocol. So this is the kind of work that we are excited about, that we specialize in.
Yeah, I'm curious. Well, I mean, let's take a look at the dashboard on Ultrasound Money, and this gives us kind of an idea of kind of what's going on here. And one of the great shills around the Ultrasound Money narrative was that ETH would become deflationary, and so we can see here the supply chain since the merge, 76.22 is going up. It's going down. Has gone. The supply had this massive dip, and it's sort of starting to trend upwards again. And will the burn be greater than the issuance? And again, we're seeing base fees trend up. It's kind of wild to think about this entire ecosystem of economic actors that have simply just lost their jobs overnight. And I'm kind of sort of wondering where they go next. But just from a philosophical perspective, how do you view that? And what do you think about validators and who they are and their reputation and their trustability in this space? Is that anything that factors into your thinking when it comes to onboarding, major institutional investors into this space?
Yeah, I think I'm a big fan of proof of stake, and I'm very happy it finally happened, for sure. There is sometimes criticism that it will be less decentralized, but I don't believe so. I think we have something like almost 450,000 validators on Ethereum, and I think that will only go up. Now anybody can, through delegated staking, anybody can become a validator or part of a validator. Of course, there is still some centralization around pools. That's inevitable, but that's okay. I think these pools aren't very sticky. So I think it's good. I think it will actually aid decentralization. And when it comes to institutions, institutions, they are looking for providing yield to their customers. It's something that they haven't been able to do, of course, for a long time because of very low interest rates or even negative yields in Europe. Now that is, of course, changing a little bit, where real world yields are going up again, which is again a good reason for integrating these real world assets into DeFi, because they already come with intrinsic yield. Whereas now in the current crypto winter, the yield on the borrow fees on stable coins has reduced drastically. So the DeFi yields have gone down, of course. So it's a good time for real world assets to enter DeFi. And I think with regard to the merge, I think the major benefit of this proof of stake is that now finally we will have the largest proof of stake chain, by far. Of course, we already had some others like BNB and Avalanche and XDC and so on, but Ethereum is just so much bigger than all those. So I think this will now bring the major benefit of introducing a stable and liquid yield curve, which is great for institutions. They can work with that. They can provide financial products to their customers for that, either directly or by using DeFi protocols in the back end. I think the other chains will also quickly converge around this new benchmark rate that Ethereum will create. And of course, this will still be significantly higher, at least for the foreseeable future, than, let's say, the current risk-free rate of the bond markets.
So can you give us some numbers around that? What is the size of the bond market compared to the DeFi market?
Oh, that's a good question. I'm not sure, but I think it's around $130 trillion. That's the fixed income market. And if you look at the DeFi market, all of the DeFi market, I don't have the latest numbers, but last time I checked, it was around 200 billion. So
I think it's less now. I think it's less.
It's less probably.
It definitely got up there. But yeah, I think it's somewhere around 100 billion at the moment.
But it's just a tiny fraction of the bond market.
Yeah. And that's the thing we've heard for so long, and it was always back in 2017. The big defining narratives were there's going to be some form of ETF for Bitcoin, and the other one was the institutions are coming. And then the institutions sort of did come, and everyone went, "Oh, we don't like this very much because this is kind of mainstream, and we're not mainstream. We're anarchists, and we like to be over there, and like we could get there, but we don't actually really want to get there." Is this the moment for you then where crypto grows up, in a sense?
Yes, I definitely believe it is. And to be honest, we work with a lot of institutions. We have large clients. I don't know if it's okay to mention them, but for you, but we have clients like State Street and Wisdom Tree Asset Management and US Bank. And we're talking to countless asset managers in the US, in Europe, stock exchanges, and here in the Middle East, where I'm based. Everybody wants to get into what we call institutional DeFi, right? So they want to tokenize their assets. They want to liquefy those assets. They want to put those assets to work on DeFi. They don't want to tokenize for the sake of tokenization. They want to put these assets to work. They don't know exactly how. One problem is, of course, regulatory uncertainty. I think, every month that passes, slowly progress is being made there as well. We've seen in Europe will soon implement, in about 18 months or so, implement an entirely new regulatory framework around digital assets, which is quite friendly, based on I would say the pioneering jurisdiction of Liechtenstein, where you can already have blockchain as the ultimate source of truth for instance, an equity register or a fund register. So I think that's great news. The US will never be the first here when it comes to accepting a Bitcoin ETF, but you see already others have already done it, like Canada, and so eventually the US will be there as well. And when that happens, of course, then the floodgates will be opened. But the other point was, I think that the fees, the yields in DeFi were so variable. And that they were quite useless, right? That they are not very useful if they vary one day. Within a month's time, they go from, let's say, 80% to 5%, right?
Well, it's a casino, and it's a rapid innovation casino where a lot of things were tested out and tried and failed, but a bunch of things actually worked. And then you saw some really genuine innovative products like Alchemix, for instance, which is a time-based loan, which it seems like it should be impossible, but like I genuinely think an ETH product on Alchemix with a predictable yield like this entirely works. And that's the kind of thing that you want to see, where it's like, this makes so much sense. If your only debt is time and you allow the yield to pay itself back, that's a game changer, a genuine game changer. Maybe not so much for institutions, but I think it's when Elizabeth Warren stands up and demonizes DeFi the way she did, and no uncertain terms, I always wonder if deep down she really believes that, or whether this is simply a way of provoking the necessary reaction for regulation to step in. Because, of course, I know that there are conversations happening, and if you're telling me that institutions are coming in and are really interested in DeFi, those conversations must be happening. Lobbying must be happening at certain levels to ensure that this can happen. And so when we think about the merge, there's obviously the technical side of it, but in terms of the message it sends to the rest of the world, it's pretty profound. And it's interesting to hear your side of it, that there is so much appetite, because I would have thought instinctively that if the US is so anti-DeFi the way it came out end of last year and into this year, why would anyone step in? Why would they be interested? So for you to tell me that they really are, and they're very excited about it, that sends a big signal as well. But I'm not sure we're seeing that reflected in the overall markets.
Yes, it's still early days for sure. And you mentioned Alchemix. It's a really good example. Many other protocols that have been pioneering, and they've been doing so in a gray zone, regulatory wise. Of course, we see very progressive regulators at the SEC as well as at the CFTC. The new head of the CFTC is very open towards innovation. And there's an understanding that yes, I mean, there shouldn't be any kind of special favors to the world of DeFi, but also it doesn't make any sense to just shape the world of DeFi in the picture of a New York Stock Exchange. It is radically different technology and global setup, of course. But then, of course, you have then other examples like Olympus DAO, for instance, that was, I think, at some point providing 11,000% yield, and that's of course collapsed. So you have, and then you have a lot of in the middle, right? And I think for institutions, the stable yield that you can get through proof of stake is great. They can build products on that. Of course, it's, let's say you earn 6% yield on Ethereum. That's interesting, but it's not as interesting if the volatility of Ethereum is then 10%. That's still for most retail investors, 90% of retail investors that don't understand and don't want to know anything about blockchain, and understandably so. That is still not a great product. So we will see that you will have DeFi protocols, you will have banks and asset managers and fintechs themselves come up with new products that hash out that underlying crypto volatility, and you can then have pure yield products or yield based on stable coins, for instance. You will have all kinds of structured products, and of course with some added compliance, there will then be spillover into the traditional bonds and interest rate swaps and options markets as well. And that's where you can finally jump from this 100 billion or 200 billion to to the trillions.
Everything is a scaling problem. Everything is a scaling problem, and it's always felt like there needs to be a moment where a substantial amount of new money comes in and reshapes this. And I think what's interesting, you said that a lot of other chains will try and kind of match the Ethereum rates, which would probably be a healthy thing. There was this danger that everyone was trying to over deliver on yield, and it wasn't very safe. But I do think there will be other chains that will try and innovate on that level, and maybe we'll see some new products come up. I'm always interested in tranches, junior and senior tranches. That's always really fascinating, just to hedge the volatility and to some degree. I don't know if they scale on at the level that we would want, but it'd still be interesting to see whether those junior yields are enticing enough to bring that to bring in the volume that makes the senior yields make sense. That would always be interesting. But this is like wherever there's an opportunity, there's somebody willing to take that gamble, and that's not always the case in traditional markets. And maybe that will be regulated out of existence. But it's definitely interesting. We've got a statement from Justice here on the comments saying the Ethereum will now become a security now that it's a proof of stake consensus. Any thoughts on that?
I mean, those arguments were made also when Ethereum was proof of work, of course. But I mean, and that's a big debate. I don't think it will. I think that ship has sailed. But yeah, that's a whole debate.
In a world where it is declared a security, that has knock-on effects for everything else, and everybody in crypto assumes that this is a bad thing. But does it have to be a bad thing?
If you make it a security, let's say if the US says it is a security, then it will fall under its jurisdiction. Then it becomes much more difficult to offer it to retail without the prospectus, without registrations. It will definitely no longer be permissionless access, right? But I think it's very difficult to make that case when it's clearly it's clearly. Well, I wouldn't say it's clearly, but in my opinion,
I guess it all hinges on the Ripple court case. So Ripple versus the SEC. Let's where
Yeah.
well, we shall see. We shall see. I mean,
We shall
waiting
see.
for the results of that one with great interest. But you know, the feeling has always been in this space that there are actors who are willing to really test the limits of what is and isn't acceptable, and that's kind of our it's the fun bit about this space, is that we really get to see all that stuff and live on the edge. And I just worry that when things get too sensible that we'll lose that, because it's been one of the most fun things about being in this space in the last 4 years, is just like seeing what ideas get thrown out there and tested and then sort of discarded so quickly.
Yeah. And
We've seen some genuine innovation, you know.
And that's true. And I would say also, I mean, the institutions that we work with, they also want this to be, as permissionless as possible and as global in nature as possible. They, a big part of blockchain for them is really a distribution case. And if that can be a global distribution case, then that's just fantastic. But they also know how, better than anybody else, they know how inefficient the current financial infrastructure is, right? So they are also very much looking forward to tokenizing derivatives, tokenizing collateral. We've been working with one bank on tokenizing collateral for FX swaps. They say that using blockchain technology, they can reduce disputes on derivatives transactions from almost 17% of all transactions to maybe 1% or close to 0%. And that will just also be, from an efficiency point of view, be a huge win for them, right? So it's not that the institutions are against it. They also see the value of this efficiency and global distribution, and of course of finally being able to provide yield products again to clients. So
and do it over the weekend as well. The 24/7 markets,
exactly,
that's a big deal. Like, there's no bell.
Yeah.
It just goes on, which is very modern, but it seems sort of anachronistic somehow that, come 5 o'clock on a Friday, you're done. It's like, I'm not done, just getting started. It's
yeah.
So you try telling a bunch of Gen Alpha that that's how it was, and they'll look at you and just go, why?
Yeah,
and then you have to kind of
because
explain to them, like, well, because people had regular jobs and they went home, and that's how financial markets worked. But why? But why?
Financial infrastructure will be on internet rails, and that's kind of inevitable. It's kind of hard to imagine it on otherwise, right? So and transactions and having value will go on chain. I mean, it's the internet of value, in my opinion, is desirable, but also inevitable. It's just a question of time, and it's of course good that regulators are cautious. There is, in the world of blockchain, I mean, a lot of projects have given it a bad reputation, and that's where companies like Securrency provide this level of comfort with regulators, with institutional clients, and of course with their clients that don't want to think too much about or worry too much about losing their private keys or being hacked. That's just unacceptable. That will be a feature that cannot be a feature. So that has to be abstracted away, and that's kind of things that we're working on. So you mentioned, is it bad that a crypto becomes a security? Not necessarily. The technology is ready, so we can, in our compliance oracles, for instance, configure multi-jurisdictional level rule books so that value can flow from a banking system or an asset management system onto a blockchain, onto another blockchain, from one jurisdiction to another. The technology is already there. So it's just that, of course, security regulations is still very, very local. But even so, it is already configurable in technology. But nothing is as permissionless and accessible as an Ethereum or a Bitcoin. We're not there yet with security tokens, but we're getting there.
Yeah, it was always the great promise, again, of 2017, that we would have fully liquid security tokens, and then the exchanges they couldn't get them off the ground. There just wasn't the demand, wasn't the appetite, and they became shitcoins, and that was sort of what they were supposed to not be. I guess the question for me is, like, what do the institutional people that you talk to think of retail and the way retail behave in these markets? Do they worry about that? Is it something that factors into their thinking at all? Or is it simply like, well, they'll do their thing and we'll do our thing? Because we're existing on the same network and participating in the same way on the same networks, just not at the same scale.
Yeah, I think, institutions are very excited about being able to offer products directly to retail. So as I mentioned, a big part of the promise of blockchain is distribution, and the same will be the case for DeFi protocols and fintechs. But it's all just a question of having proper risk management in place, disclosures, analytics pages, and some comfort around the security of funds, right? So, for instance, in our case, the tokens that we produce, they have the so-called recall feature or clawback feature, that in case there is a loss of funds, there is an on-chain cap table that can be verified. These tokens can be reissued. They can also post-issuance be upgraded with, for instance, a new dividend or new utility feature. So we are working on this type of technology just to make it to make crypto really useful in the real world, I would say.
This is the real world, though. That's the thing, and I think that phrase gets used a lot because we feel like the crypto world is not the real world, but for a lot of people, it is the real world, and that's where I think it's like this idea that people who don't own any crypto are like muggles in Harry Potter. They haven't experienced the magic of internet money. But when you say in the real world, it's sort of saying anyone above the age of 25, but anyone below the age of 25, that's not really them. Do you know what I mean? It's an odd turn of phrase, but like
I don't know if it's age related. When I say real world, I really talk about the numbers of people. So I know a lot of 50 years old that are very, very familiar with blockchain technology, but most of the 20-year-olds, I would say still over 90% really don't understand how blockchain or crypto works, right? So the real world for me is, to bring DeFi, for instance, into the back end of the likes of Revolut. Revolut they have the customers, and the banks have the customers. The DeFi protocols, you can count these customers in the tens of thousands if they're lucky, not in the millions. Yeah.
And it fluctuates horrifically. Like you would look at those numbers in 2021 and it would have been massively inflated. That the pandemic had a big role to play in that as well.
Yeah.
But we know the world has this habit of turning right when we think it's going to turn left. And it's very difficult to plan for that. But I think what's heartening from what you're telling me is that there is this feeling of confidence in this one great big network, and that it will allow other networks to just relax a little bit, because if they just follow in behind, then they should be okay. And I think that's a great piece of news for everyone who kind of isn't just in this for the gambling. So that's nice to hear.
So I see, the difference with the 2018 bear market is that we see that there's still a lot of venture capital and strategic capital available for innovative crypto players. So that's one big difference. And the other one is that I think the narrative that Ethereum will be like the only chain, I think most people now are accepting that it's going to be a multi-chain world, and I think that's a good thing. And I think that regulators think that's a good thing as well, because they don't want over-reliance on one particular. There are, of course, still a lot of technical details that need to be sorted out when it comes to having value flow from one chain to the other. But again, there is a good number of very high-quality tech startups working on that, and these guys have no issue raising capital, and that's because there is this institutional appetite to make this happen.
Interesting. So what do you think the timeline is for major adoption of ETH 2.0 based products from the bigger players? How long do you think that's going to take to kind of really sweep in?
Yeah, timing is always the difficult one, of course. But ourselves, we've been if you look at the currency, we've been operating more or less under the radar for about 5 years now, creating a lot of technology. And of course, none of it makes the news because it's all infrastructure, and we haven't done any wild token offerings or anything like that. But we've been working on building these, I would say, compliance aware value rails that interact with banking systems and asset management systems without the need of ripping those systems out. Because that's a no-go. So we now are ramping up, where in Q4 there will be quite a number of high-profile token offerings. So Q4 of this year, we see also with DeFi, we see the banks now getting into places like MakerDAO and others, and Aave. And so it's just starting now. So I think we're really at the cusp of it. Everybody was a little bit nervous about the merge. Now that the merge went ahead so flawlessly, I think that will provide another boost. So I think next year you will finally see real institutional adoption. And when I say institutional, not just from hedge funds, but from stock exchanges, from large custodians, from large asset managers, from regional banks, even from sovereign wealth funds like we have here in the Middle East. And so I think, next year is going to be very, very interesting.
Yeah, it's always been one of the sticks that Ethereum gets beaten with, which is they announced proof of stake years ago, and then it just didn't happen. It didn't happen.
Yeah.
And here we are sitting there, and it's happened. And I think it's worth taking a moment just to kind of salute the army of developers who held in their hands the fate of just an enormous amount of value. I mean, compared to the traditional financial markets, maybe not so much, but it was still a huge kind of gambit to make that thing happen. So congratulations to all the devs. Good job. I know it was tested to infinity, but like still, it's a nervous moment when this actually happens. And it's easy to forget that they work insanely long hours in code that we don't understand, with decisions that have huge ramifications for everything. So it's definitely worth saluting them. Good job. So
definitely, they're changing the world.
Last question I had for you, just kind of thinking about what you think might be the kind of killer product, the one kind of breakthrough thing that would ignite this TradFi invasion of our space.
So the killer product. So I think having this, having fixed income, having a yield curve for DeFi, I think is the killer product. Then from that you can then have yield only products. You can have you talked about tranching. That's a big one. For instance, now every protocol, every DeFi protocol is offering stable coins. We call it stable coins, but really they're kind of high yield bonds, right? So let's say that we can call it what it is, so we don't have to call it US dollar, X or whatever. It's going to be a high yield bond, which has disclosure, which has transparency on what it's going to pay out, because it's fixed. It's not a variable income product. And then you couple that with compliance, and you can then have those instruments go out into the real world. And with that again, I mean, small businesses that are looking for financing, or pensioners that are looking for a yield, right? Or pension funds. And so I think having fixed income products combined with compliance, I think that will be the killer app of DeFi, and it has just started.
Fantastic. Well, Manuel, thanks so much for joining me. It's a historic day as the merge goes live, finally on Ethereum mainnet. You can catch up all the news on the Defiant website. But for now, thanks very much to Manuel Rensink from Securrency for joining me for this kind of slightly far-sighted look at the repercussions of this historic moment. Manuel, thank you so much for joining me. That was very insightful and helpful.
Thanks for having me.
And now we must hear from the people that make the show possible. Manuel, I will see you very soon. Bye-bye.
Thank you.
Optimized
Bye.
for security and sustainability, Aura is bringing strong yield on stables, Ether, and key DeFi assets back to Ethereum. Aura is trusted by over $300 million in TVL from users and DAOs like Balancer, Gnosis, Rocket Pool, Notional, and Olympus. Visit aura.finance today and participate in protocol governance to get access to DeFi's newest home for reserve assets. You're just clicks away from making your idle assets productive. Galaxy is the leading Web3 credential data network in the world. This collaborative credential infrastructure enables brands and developers to engage communities and build robust products in Web3. With Galaxy, users can explore Web3 and learn to earn campaigns with over 700 partners. On the other hand, builders have the opportunity to create growth campaigns on a seamless plug-and-play dashboard. Galaxy is constantly innovating, introducing Galaxy Passport, the one-click solution to verifying Web3 identities. Mint yours today.
And yes, I'm still here, and now it's time to end.